Today on InvestTalk, we covered a very niche area of investing, answered questions on tariffs, taking profits, and ticker OLED, and then ended the day talking about potential danger for the Eurozone.
This is InvestTalk, independent thinking, shared success.
Now, my main focus point today concerns a niche investment opportunity, and that is property tax liens. Property tax liens are an overlooked investment area that can really offer big rewards, but with some serious risks. When property owners don't pay their taxes, local governments place a lien on the property and sell that lien at auction. For investors, this means a chance to earn returns through collecting back taxes plus interest. Before you dive in, it's crucial to understand that the process can have some pitfalls. And so here's how it works. When you buy a tax lien, you're essentially paying the delinquent taxes for the property owner. In return, you get a legal claim on the property. The owner then owes you the taxes plus interest, typically between 10 to 12%. And if they pay up within the redemption period, which can last from 6 months to 3 years, you make a profit. If they don't, you could end up foreclosing on the property. Sounds straightforward, right? Well, not always. First, there's competition. Auctions, both online and in person, often see bidding wars that can drive down your potential return. Then there's the property itself. It's essential to research the property before you bid. There can be some hidden issues. It could need repairs. It could be in an area that is susceptible to damage, environmental damage, storm damage. There could be other outstanding liens that can turn a promising investment into a money pit. And so for those who want to get in on tax liens without the legwork, there are these funds that are available. There are property lien funds that are managed by professionals. These funds, what they do is they pool investor money to buy liens, offering a more, I would say, passive approach to investing. In short, tax lien investing can be profitable, but it's not for the unsophisticated investor. It requires research, requires patience, requires a solid understanding of global real estate trends, but local real estate trends as well. And so for those who know the ropes, it can be a unique way to generate returns, to say the least. So just be prepared, because with big potential comes big risk, and understanding the risks of an investment is a critical part to investing. Don't miss out on critical market updates. Subscribe to the KPP Premium newsletter for weekly insights delivered straight to your inbox. Let's talk about the market today. U.S. stocks were mostly lower, ending just off of worse levels. The weakness really following mixed performance last week, though the S&P and NASDAQ were boosted by the strength of a particular area that didn't do too well in November. That was big tech, NVIDIA. However, a notable decliner on the announcement that China is going to be looking at it from a regulatory perspective. Financials also down, with banks, life insurers, credit cards all on the defensive today. Relative outperformers, commodities, China tech among the standouts today, with help from the latest bounce in the China stimulus sentiment as well. Dollar index up 10 basis points, with the yen notably weaker. Gold finished up 1%, and crude oil ended up 1.7%. Still, it seems like stretched valuations is the go-to excuse anytime there's a pullback, while sentiment and positioning really remains mixed. The market's in waiting mode ahead of CPI on Wednesday for more color on the December FOMC policy decision. Probability of another 25 basis point rate cut is holding steady at about 85% after odds jumped up 15 percentage points on Friday following the mixed November employment data. Over the weekend, the news was really dominated by the collapse of the Assad regime in Syria, though interesting to note the global markets really had a limited fallout. Biggest story today seemed to revolve around the ramp up in the China stimulus sentiment, and M&A activity also in focus, playing into the post-election deregulation theme, something we will touch on if we have time at the end of the show. Quiet day overall for economic releases, though. Wholesale inventories for October were in line with expectation, and FIB small business optimism, and final Q3 non-farm productivity and unit labor costs on the calendar for Tuesday. CPI, the big macro highlight of the week on Wednesday. Consensus estimate is looking for a 30 basis point month-over-month increase in November, pushing the year-over-year rate of growth to 2.7% from 2.6%, while core rate also expected to increase 30 basis points month-over-month, leaving the year-over-year rate unchanged at 3.3%. PPI and initial claims out on Thursday, and import and export prices cap off the week on Friday. Also important to note, no Fed speak this week with the blackout period into the 18th FOMC announcement.
Hello, guys. I would like to ask you about Devon Energy, DVN. Is it time to buy this company? It's going down. Everybody loves oil now. Drill, baby, drill. Should we invest in this company or wait a little bit longer? What would be the price if that happens? Thank you very much. Bye-bye.
Man, I feel like we've gotten multiple calls about Devon Energy in the last couple weeks. And so let's talk about Devon Energy, ticker DVN. Devon Energy is an energy company. They explore, develop, and produce both oil and natural gas. And as a lot of energy companies, they have been down recently, down 14% in the past 3 months, down 21% year to date. The revenue looks exactly how you would expect the revenue to look. From about 10 billion in 2018, projected to be about 15 billion, though down from the 19.8 billion in 2022. Their margins look solid, but still on a downward trend from a high of 30% net margin to 19.3 this year, but their cash flow hasn't really been down as much as their profitability has. Now they have very little debt, about 9 billion on a $22 billion market cap company. They pay a dividend yield, about 3.5 is where it is now. And that dividend has fluctuated with their revenue and profitability. But I mean, this is what you expect of a company that is selling oil, selling energy, selling a product that can be volatile. And so their revenues are going to be more volatile. Their profitability is going to be more volatile. Now, you mentioned drill, baby, drill, and we talked about that several times in that you can say we want to drill more, but Exxon comes out and says, well, we actually don't want to drill more. So I think that the most beneficial thing, specifically for natural gas, and remember, Devon Energy is not just an oil company. They're about 50% oil and natural gas, right? Natural gas stands to benefit greatly from streamlining of the pipelines, from efficiency and cost reduction of getting gas to market. And so I think that's where Devon Energy stands to gain a lot. And so if you're looking for an energy company that gives you not just exposure to oil, but pretty even exposure to oil and natural gas, I think Devon Energy is a good way to go. It's up 1.4% today. And so you ask, when is the best time to enter? And to be honest, I mean, it broke down below 35, sitting right there. It's still on a downward trend. It could continue downward, but you know what? That's the beauty of dollar cost averaging into a name. And so I think with oil prices as low as they have been in a bit, and the benefits that are on the horizon for not just oil, but really natural gas, I think Devon Energy is a good name to enter. Thanks for the call. Here's another YouTube channel question. As I think you know, we also post our podcast in video form. So if you go to InvestTalk with 2 T's on YouTube, and you have a question that comes to mind, just leave it over there in the in the comment section. This one is on ticker SBLK. And it says SBLK is a stock I've been interested in. It's low P/E and low price to book. And because of that, it caught my eye. Do you think this company is undervalued? So SBLK is Star Bulk Carrier Group, and they do not make spaceships, though. A lot of times, some of the questions people ask about are companies that do not make any money. This is not one of them. Star Bulk Carriers Corp is a global shipping company. And so what they do is they transport dry bulk commodities around the world. They actually ship more than 70 million metric tons of cargo annually. That is a lot of cargo. Now, over the past 5-6 years, they have revenue growth of about 8% on an annualized basis. And that's been pretty steady, though most of the revenue growth was really coming out of the pandemic, as would be expected. So they hit a post-pandemic high in December of 2022. And so it's supposed to fall from 1.4 billion to about 1 billion this year. But in that time, their margins have remained pretty good. Before the pandemic, they actually lost money in 2019. The year before that, they had a net margin of 9%, projected to be 29.3% this year, though notably still down from the pandemic high of over 40%. Now, year to date, down about 23%. And from a relative strength perspective, it's pretty closely followed the S&P 500 over the past 5 years. Cash flow, though down from 2022, is trending in the right direction. They have a little bit of debt, $1.4 billion, but you know what? They're a pretty small company, $1.8 billion. One thing that strikes me is their dividend yield, 15.3%. 15.3%. And their payout ratio is 89, meaning they are pretty stretched on that dividend, and it is likely that it could be cut. And so if you found this name because you're like, wow, I love this high dividend yield. Dividends are not set in stone. We say it all the time, but I have to say it again. Dividends are not set in stone. Now, I think the thing to me that, again, strikes me more than anything is high debt levels. It's a capital intensive business, yes, but it's also a cyclical business. And so when you're running on these type of margins, or rather this type of leverage, if there's a downturn in global demand, if there are things that prevent ships from coming into port, be they weather disasters or geopolitical issues, well, if you have a lot of debt on your balance sheet, that becomes a burden for a company such as this. And maybe that is why it is trading at cheaper valuations. Price to book of 0.8. It's trading at less than its book value. Price to cash flow of 3.9. Honestly, what I'm seeing here is a company that has not done well. Revenue growth has fallen since the pandemic. They're kind of mean reverting in their profitability. Cash flow kind of headed in the right direction this year, but still pretty minimal. Debt load pretty high, payout ratio incredibly high. So for Star Bulk carriers, going to have to pass. I think there are better opportunities out there. If you're looking in the shipping industry, I would look elsewhere.
Discover more valuable information at InvestTalk.com.
Hey, Justin or Luke, Joe from South Carolina here. Just a question. Whenever you have investments in like the S&P, ETF, VOO, or VOT, or those types of indexes, I hear you guys talk about taking profits. I'm invested mostly in IRA or Roth IRAs, so they're all retirement accounts. Does it make sense to take profits? I know the saying is kind of when times are good and you're feeling really good about your investments and you're up really well, you should look to take profits, and when everything looks terrible, you should look to buy some more. And it's kind of been doing really well lately, so I'm wondering if it's time to maybe sell some of that and take advantage of the gains that I've gotten, or if that's more of an individual stock strategy, and when you're in these indexes, that it just makes sense to leave it in there and just let it go. I'm 30, so I have plenty of time for it to go down and come right back up again before retirement. Thanks so much, and I will listen for your answer on the podcast.
So this is a great question. Generally, when people talk about taking profits, they are talking about individual companies because your investment strategy is allocated between X number of companies. Some of them will go up, some of them will go down. And when you're up a lot on a security, well, you want to lock in some of those profits. And so what do you do with those profits? Well, you rebalance them to other names. Now, similarly, this could be applicable in your portfolio. Now, if you only invest in the S&P 500 and that's the only thing you put your money into, well, then you wouldn't really want to take profits because we do know that time in the market beats timing the market, and you have a long investment horizon and you nailed it on the head. You have the ability to ride the wave of volatility up and down. And so if the only thing you have is an S&P 500 ETF, well, then what would you be taking profits for? And so no, you wouldn't want to do that. But if your strategy, if your portfolio includes many different ETFs and you are trying to target allocate them based upon a decision you have actively made in your portfolio construction, well, then you would want to take profits because that gives you an opportunity to rebalance. And so in a way, you can think of that as being anecdotal to individual securities because you have various weights that you're ascribing to various investment vehicles. And so taking profits affords you that opportunity. I think it all comes down to what is your strategy like? If it's a one ETF strategy, then you're not really going to take profits because you want to keep it in the market. So hopefully that helps. Thanks for the call. Let's play two in a row from 888 and 99 chart.
Hi, InvestTalk. I wanted to see if you guys could do an evaluation of Progressive. The ticker is PGR. I'm curious if you think it's a good investment. It looks like they are primarily focused on insuring automobile, and what you think of that type of insurance versus other types. I know you guys have talked highly of insurance companies on other episodes, but there's definitely different types. I'll listen to your show on the podcast. If you guys don't like this one, if you could direct me to another type of insurance, I know you can't name names, and I'll listen on the show. Thanks. Bye.
So Progressive Insurance is an insurance company. They do insure other types of things, but generally they do make a lot from their car insurance. They have property insurance that only accounts for about 4%. Their personal insurance is primarily for car insurance, and that's about 74% of their business. Now, their net income has grown pretty substantially over the past 5 years, from $2.6 billion to $7.9 billion, where they're projected to be this year. And in that time, earnings per share has grown as well, from $4.46 per share, all the way to $13.12 per share. And that's pretty solid growth. That is a pretty solid growth rate. Now, the question is, what are some of the macro variables that could potentially be hindrances to this company? Well, one is the cost of repair becoming more expensive, parts becoming more expensive, shipping becoming more expensive, geopolitical tensions causing the latter, trade war causing the former. If you have people that are using their insurance and it costs more to repair cars, well, that would hurt margins. Now, this name is up 55% year to date, up 53% on the past 52 weeks, though notably down 2% today. In 3 months, down 1.37%. Forward-looking price to earnings sits at 18. That's pretty expensive for an insurance company. Return on equity is pretty high, but the thing that really strikes me about this is one of the big benefits of insurance companies is dividend yield. And this is a pretty low yielding name, only about 20 basis point dividend yield, much, much lower than its peers. It's also run up a lot since 2021. And so I just don't think the value for what you're getting is there right now in Progressive. I think that there's going to be a lot of issues with the insurance markets. One, because you have some that are insuring areas of the country that are going to be more susceptible to more damaging storms in the coming years. See what happened in North Carolina, what happened in Florida. For auto parts, well, I think that you have some of those macro headwinds that I mentioned, increasing costs. Either way, I think that Progressive looks a little stretched to me, and you're not getting much in terms of yield compared to its peers. So overall, even though the growth has been pretty solid, this chart looks ripe for a pullback, and so I would look elsewhere. Thanks for the call. Now, foreign firms in China they're facing a bleak reality, despite official reports from the government claiming otherwise. According to China's Council for the Promotion of International Trade, 90% of foreign companies are reportedly satisfied with their operations in the country. The government insists China's open for business and reforms are making life easier. But for many foreign executives, the picture couldn't really be more different. Companies like General Motors are pulling back, with GM recently writing down over $5 billion in its Chinese joint ventures. Meanwhile, China's opening a competition probe into NVIDIA, which weighed down on the stock today. Western businesses, honestly, they once saw China as a gold mine, as the next frontier, not just for cheap manufacturing, but because it has massive market potential. That is a lot of consumers. But sales peaked in 2021 when they hit $670 billion. And those numbers are slipping down to $650 billion this year. And the trend's continuing. It's continuing downward. Companies from Apple to Volkswagen to Starbucks to Louis Vuitton, Moet Hennessy, LVMH are reporting declining sales in China. Now, a key reason is, well, first and foremost, China's sluggish economy. Despite government efforts to boost the economy, property sales keep falling, and deflationary pressures are still persisting. There's also oversupply in sectors like electric vehicles and building materials, and so that's sparking some pretty brutal price wars. Adding to the challenges, Chinese competitors are really gaining ground. Luckin Coffee now boasts 21,000 stores in China, far more than Starbucks has. It's not just about retail, not just about coffee shops. In tech, Huawei's latest smartphones are giving Apple a run for their money. And Chinese EV makers like BYD and NIO they're offering innovative, lower price cars than Western brands are really struggling to match. There's also geopolitical tensions that are making matters worse. Recent U.S. export restrictions on chip-making tools hurt American firms like ASML. American firms like Applied Materials and Dutch giant ASML rather. In response, China's called for reduced purchases of American chips and launched a probe into NVIDIA. And so other industries are also feeling it, from luxury goods to fashion goods. European brandy makers and clothing retailers like Uniqlo all face backlash due to trade disputes and forced labor allegations linked to Xinjiang. And with Donald Trump threatening more tariffs on Chinese goods, tensions could escalate. If this happens, Xi Jinping's government may retaliate further, making it even harder for American firms to operate in China. Foreign companies now find themselves trapped in a geopolitical storm, and the outlook does not appear as promising as it did a decade ago. Let's shift back to the InvestTalk Anytime listener line and answer this question now.
Hi, thanks for your show. Want to get your opinion on buying AMD, ticker AMD. I've had this on my watch list for a while. I notice it's down 6% as of Monday, December 9th. Thinking about this one for a more medium, long-term investment. Look forward to hearing your thoughts. Thanks so much for your show.
So ticker AMD, Advanced Micro Devices, is similar to NVIDIA. They're a GPU graphics processing graphics card company, and they kind of play second fiddle to their older brother. And they're down 5.5% today. NVIDIA down as well on the back of what we just mentioned, a Chinese probe. But the question is, does AMD have growth potential to maybe swallow some of the market that has been dominated for so long? And so let's dive in. AMD, though it is the little brother, as I said, is still a big company. $229 billion market cap. That is billion with a B. And it has very little debt, right? $229 billion, $2.2 billion in debt. The reason why is because they issue a bunch of shares. Now, revenue growth is solid, 28.5% on an annualized basis over the past 6 years, from $6.4 billion all the way to $25 billion this year. And revenue still grew from $22 billion to $25 billion year over year. Return on equity, pretty solid, 9.3%. Net margins growing from 3.8% to 20% this upcoming year, though notably lower than the pandemic high of 25.6%. Free cash flow looks pretty solid, projected to be $4 billion this year. It's taken a dip from in the pandemic, where it was really peaked out in 2022 in terms of free cash flow growth. But overall, what I'm seeing is a company with a relatively strong balance sheet, profitability headed in the right direction. It looks like it's been consolidating after hitting a 52-week high back in February or March. And honestly, compared to a lot of companies in this space, looks pretty cheap. They're trading at 27 times forward-looking earnings relative to 34 is their 5-year average. Price to book 3.9 relative to 12.8. Price to sales only 9. And so honestly, this looks pretty attractive now. Now, my main issue here is that technically it doesn't look great. It's been heading lower since February, and it continues to head lower. Now, if it starts to consolidate in the 120 to 130 range, if it really starts to consolidate above 125-ish, then I would start to think about getting into this name. I think one of the big benefits here is you see remarkable growth, you see margin expansion, you see excellent cash flow. Now, they do issue a lot of shares, but they haven't really issued shares since 2020. I'd like to see maybe a share buyback program like you see with some of the other big names. But either way, I think this is a name that is surprisingly not as expensive as some of its peers. Thanks for the call. Let's dip back into the YouTube channel comment section and answer one final question from there on ticker OLED. It says, I have a full position in OLED stock and noticed recently the stock is down over the last 5 years and 1 year even, though earnings and revenue is growing and the margins look fine. Why do you think the stock has underperformed, and do you think I should move on? Well, OLED is Universal Display Corporation. What they do is they research, develop, and license technology for displays, OLED displays. Think TVs, think iPads. In a couple years, you have the MacBook Pro is going to start using OLED displays. It's going to be in some laptops as well. And so going back to 2020, well, their relative strength dropped off. Now they're down 17% this year, down 18% in the last, 17% as well in the last 3 months, down 9% in the past year. They've been underperforming their industry headed into 2024, underperforming the S&P 500. Now, as you mentioned, revenue growth looks fine, 15% on an annualized basis. Margins look fine as well. honestly improving. And so the question is, why isn't this company doing particularly well, even with its revenue growth increasing pretty significantly? And that's because it was incredibly expensive before. It's still kind of expensive, trading at 29 times forward-looking earnings, so its average is 37.7, trading at 29 times its cash flow. This is a situation where you had a technology take hold right before the pandemic, being used in all sorts of new televisions, being used in all sorts of new laptops, being used in all sorts of new tablets, and their valuation exploded. At one point, they're trading at 64 times forward-looking earnings. And so what we have here is, frankly, a company that's coming back down to reality. Now, there are a lot of potential boosts on the horizon. As I mentioned, other companies getting them more involved in personal computing. But still, it looks pretty darn expensive to me. And so I'd keep it on my watch list because I think it's an important technology. But it's still, even though a little cheaper, is expensive. Thanks for the call. Thanks for the comment. We appreciate your time.
If you enjoyed this video, please like and subscribe for more engaging content in the future.
Hello, InvestTalk. This is Jose from New York. I'm calling about a stock called Veeva, ticker symbol VEEV. I went over the fundamentals and it looks pretty good, but I'm a bit concerned about the high PE ratio. I'd like to know what you think, if it's a good stock to invest in. Any information will be helpful. Thank you for your help.
So ticker VEEV, Veeva Systems, is a software company that provides cloud-based CRM, all sorts of solutions for healthcare companies. Now, one thing that I notice is pretty good revenue growth, though it has slowed down a little bit from 22.3% annualized over the past 5 years to about 16% this year. Slowed down a little bit, though not a crazy amount. One other thing that I notice, as you already pointed out, is it's very expensive. Now, they have very little debt, $72 million in debt on a $40 billion market cap company, but they also issue a lot of shares. They're diluting shareholders pretty much year over year. Now, cash flow is headed in the right direction, and by that I mean it's a straight line up and to the right, but profit margins are falling a little bit. Oh, no, I'm sorry. I was looking at the wrong thing. Profit margins look great. From about 26.7% 5-6 years ago to about 38% is where it's projected to be this year, though they had been heading downward. It looks like there's a little bit of a correction towards the upside this year. Now, year to date, it's up 27%, pretty much performing nearly in line with the S&P 500 and its industry. Best year, it's up 42%. It had a rough 2023 compared to its industry, right? Underperformed pretty substantially. And one thing that I'm questioning is their revenue model. About 80% of that is subscription services, which could be variable. It's not necessarily a locked-in revenue system, and that could make revenue volatile in years to come. But most importantly, it's expensive. It's trading at 15 times sales. That is very, very expensive. The growth it needs to sustain in order to justify that is just, I would say, too much. It's run up a lot. Other than the fact that the fundamentals balance sheet look good, I just think it is pretty darn expensive. Thanks for the call. Now, PIMCO, one of the world's largest bond managers, is warning that Donald Trump's return to the White House could spell trouble for the Eurozone. If Trump follows through on his aggressive trade policies, the fallout could force the European Central Bank to slash rates back down to emergency levels. Andrew Balls, PIMCO's chief investment officer for global fixed income, says the worst case scenario for a trade war could be difficult for Europe. The euro has already fallen more than 5% since late September, with markets now anticipating more aggressive rate cuts from the ECB to counter the economic strain. Traders in swap markets are betting the ECB's deposit rate could fall as low as 1.75%, down from the current 3.25%. The ECB had only recently just ended its 8 years of negative interest rates, trying to combat the inflation surge following the pandemic. But Trump's protectionist stance could reverse that progress. Investors initially hoped that Scott Bessent, Trump's pick for the Treasury Secretary, might moderate Trump's more radical economic policies, leading to a slight retreat in the dollar. But markets are kind of pricing in the optimistic outcome right now, meaning that there's really just more risk to the downside, that you're over-anticipating the moderation of the economic policy. And it's not just Europe. The UK is at risk as well. The Bank of England would need to cut rates further than currently expected should a trade war ensue. Investors are already anticipating interest rates in the UK to fall to 4% by the end of next year, but honestly, British rates have more room to drop. Despite concerns in the Eurozone, PIMCO doesn't see further turmoil for French debt markets, but still, the fiscal outlook is not great for the entire Eurozone. European markets have weathered a lot. They have weathered a lot of storms in the past couple of years, from war to pandemics to political upheaval in both France and Italy, the dissolution of French parliament. But there could be more on the horizon. If Trump's trade war takes off, the Eurozone could be in for another major test. So for now, investors should brace for lower rates, a weaker euro, and challenging times ahead. I'm Luke Guerrero, and this completes another InvestTalk program. We thank you for listening, and we encourage you to tell your friends and family members about our free podcast downloads. You can get yours at iTunes, Google Play, and Spotify, and please be sure to leave us a rate and review. Remember, we can help you better understand your portfolio dynamics and calculate your investor risk number. Just go to investtalk.com and click the portfolio review button. This is a free and confidential service. Also, if you don't know yet, we can help you optimize the potential of your 401k. Just head over, because it all starts at investtalk.com. Independent thinking, shared success. This is InvestTalk. Good night.